Hi guys, welcome back to my channel. Kelvin here. Every few days, I will make a video to talk about stock investing, like buy this stock, buy the ETF, look at my stock portfolio. But then, I suddenly realized something. I forgot to tell you guys how to start investing. Some of you guys be like, I don't even know how to start. Like Chloe commented, I don't know how and where to start or what to do. Damien yo, I got money and youth. How to start? Shining, I want to buy Tesla and what big. But how much money do I need to invest? Don't worry guys, I got you bro or sis. In this video, I'll tell you everything you need to know to start investing. What kind of investment should you choose? What stocks to buy? Which broker to use? What should your investment strategy be? Basically, everything you need to know on how to start investing. Sounds good? But before I start, I would greatly appreciate it if you can help to tap the like button. In return, I will show you a cute otter swimming. Alright, let's start right now. First thing first, what asset class to invest in? There are a ton of those. Let's quickly go through them. First is bonds. Basically, bonds are debts where you lend the money to some company or government and they give you some interest every year. Then, when the bond matures, they will return the money back to you. Bonds are the safest because as long as a company or government doesn't go bankrupt, your capital are 100% guaranteed. For example, Singapore government bonds where they give you 1% interest, or DBS bonds where they give you 2.4% interest. They basically won't go bankrupt because if they do, everyone will be in a huge trouble. If you are young, like below 50 years old, I wouldn't recommend you to invest in bonds because even though it's guaranteed return, your money will grow super duper slow, like slow until even the sergeant's armor can run faster than your money. Then next, you have stocks. There are two main kinds of stocks. You have growth stocks and you have dividend stocks. Then you might ask, why so complicated got 2-1? That's because of magic. Just kidding, there's a reason to it. Check this out. This is a life cycle of a company. First, the company is a startup. Most companies will usually fail here, like Honest Bee. But if the company succeeds, it will enter the growth stage. Here, the company will grow fast and furious, and usually the stock will grow super fast too, like Tesla stock, which had WTF moments in 2020. When the company is in the growth stage, it won't pay any dividends to you because it will reinvest the money back into itself. Then finally, the company reaches a peak and can't grow quickly anymore. For example, Coca-Cola and Johnson & Johnson. When the company is in the mature stage, it can't grow quickly, so it will pay the extra money as dividends to you. Finally, you have ETF. ETF is just a basket of stocks that represent something. You can have a basket of US stocks, a basket of technology stocks. There are a lot of benefits to investing in an ETF. It has a bunch of stocks, so it's very diversified. It's self-cleansing because bad stocks will be kicked out and replaced with a good stock. And it's cheap, like 0.3% kind of cheap, even cheaper than the rabbit candy. So here's the idea of investing in an ETF. You won't buy the wrong stocks if you buy all of them. However, because ETF has so many stocks, it won't give you super duper high WTF return. So it's a trade-off. You want high return or you want safer investment. Growth stock, dividend stock, ETF, whichever you choose totally depends on your preference. If you want to just play Animal Crossing all day long and you don't want to manage your investments and you want medium return, medium risk, go for ETF. But if you are okay with managing your investments, go for stocks. For high risk, high rewards, go for growth stocks. For low risk, low rewards, and some passive income, go for dividend stocks. Now, naturally, the next question is, what stocks or ETF to buy, Kelvin? Which one will take me to the moon? Let's talk about ETF first, because it's the easiest. For the safer ones, you can go for country ETF, like STI ETF, a basket of Singapore stocks, 3.7% annualized returns, or CSBX, a basket of US stocks, 16% annualized returns. You can also go for ETFs that represent a sector. Usually, this will give higher returns because they are more focused on a sector. For example, IUIT, technology sector, 20+% annualized returns. Or IUHC, healthcare ETF, 12% annualized returns. Or QQQ, Nasdaq 100 index that doesn't include finance sector, 21% annualized returns. Of course, there are more ETFs out there. If you want more ideas, you can check out etfdb.com/compare where they will show you all kinds of top ETFs. Next, let's talk about stocks. It's actually not hard to choose good stocks. The reason people lose money investing in stocks is because they only see the stock price. They be like, oh, this stock is going up. This must be a good stock. Or, oh, this stock is cheap. If I buy now, when it goes up, I will what big. The term for this is called investing like an ape. We don't do that here. So, when investing in stocks, there are three main things to look at. First, the company must be profitable. Second, the company must have low debt. Third, the company must be continuously growing over the long term. Easy, right? Profitable, low debt, and growing continuously. You can find this kind of info everywhere, like Yahoo Finance. For example, if I check Google's income statement, you can see that its gross profit is increasing every year. They have about 12% return on assets, and debt to equity is only 11.83, which is quite healthy. On the other hand, if I check GameStop's income statement, you can see that its gross profit is going down every year. They have negative 3% return on assets, so they are actually losing money, and have 37 debt to equity. So that's why GameStop is not a good stock. But if you are lazy and you don't want to look at financials, and you only want to look at charts because stocks, here's a very simple way to find good companies. If the graph is going up over the long term, not short term, if the graph is always going up 5 to 10 years, it is very likely that it is a good stock. For example, Disney, it is going up long term, or Apple, the fruit company, going up long term, or Facebook going up long term also. On the other hand, if the chart is either flat or going down over 5 to 10 years, then it is very likely that it is a bad stock. For example, Singapore Airlines going down, bad stock. AMC down. Yes, I know that it shot up this year, but if you see over the long term, it is still a chart that is going down, so bad stock. Take note that this trick is not 100% foolproof. It is just for you to filter out good stocks. You will still have to research to find out more whether the company is good or not. But wait, that's not all. I have one more tip for you. There's a super easy way to find good stocks. All you need to do is just look at the top holdings of an ETF. For example, US stocks, just tag CSBS. You will see all the top holdings are good companies like Apple, Microsoft, Amazon, Alphabet. Just buy this and you are very likely to do well. Or maybe Singapore stocks, just tag STI ETF. You have DBS, OCBC, UOB. However, not every stock is a good stock. If you use the stock chart going up over the long-term trick, you will see that even though Singtel and Jardine are top holdings, they are not good stocks because their stock price is either flat or going down long-term. Okay, now you know how to find good stocks. Next, how to buy stocks. To buy stocks, you need to use a stockbroker. Just think of it like you want to buy cheap China stuff, you use Taobao. You want to buy expensive broccoli, you go to cold storage. Same idea, you want to buy stocks, use a stock brokerage. There are a lot of stockbrokers that you can use, but I recommend you to use brokers that charge a very low fee. For example, DBS Vickers is an expensive stockbroker because it charges a godlike $25 commission per transaction, and it probably says that it has competitive pricing. Not too sure what the competitive pricing meant. On the other hand, Tiger Brokers charge around $1.99 total fee for US stocks. This is what a real competitive pricing means. I've already made a video comparing all the low-cost brokerages. You can check it out here if you want. But the summary is, the 3 low-cost brokers are Interactive Brokers, Tiger Brokers, and Moomoo. Then you might ask, wow, so many which to choose? I would recommend you to just sign up for all 3. The reason is because Tiger Brokers and Moomoo give free sign-up gifts when signing up. As of making this video, it's a free Apple share worth $140 for both of them. So you will get 2 free Apple shares in total. Even though Interactive Brokers doesn't give you any sign-up gift, it is still useful because of 2 things. First, it has fractional shares. This means that you don't have to buy minimum 1 US stocks. If you have only $10 and you want to buy Facebook share, can, no problem. Second, Interactive Brokers lets you buy stocks or ETFs from the UK market. For example, CSBS, RUHC, RUIT are all listed in the UK. You know they are in UK because when you search in Google, it says LON or London Stock Exchange, while US stocks like Google are NASDAQ, which is in US. If your friend has referral codes to sign up, just use theirs. Otherwise, you can just use mine in the description down below. Next, let's talk about investing strategy. There are 3 main ones. Timing the market like buy low, sell high, dollar cost average, and lump sum investing, where you all in like parkour. Which will perform better? A lot of new investors will try to time the market. They think they are Warren Buffett or something. Check this out. If you can time the market perfectly, you will get the best result. But there are a lot of research that proves that they are definitely not Warren Buffett. So they are super bad at timing the market. In the end, they will get a much lower return. So lump sum investing and dollar cost average is the best strategy. Whichever you use depends on your preference because the difference in return between the two is actually quite small. So it really doesn't matter which you use. Personally, I prefer the dollar cost average, where I just keep buying every few days. Market goes up, I buy. Market goes down, I heartache a bit, then I buy more. Over the long term, as long as you buy good stocks, you will do well. So now you know how to invest. Here are some tools that I personally use. For tracking of stocks, I'm using an app called My Stocks Portfolio and Widget. Another one you can use is ShareSite. Same thing, it will let you track stocks easily. One bonus feature is you can integrate with interactive brokers to track your investments automatically. Sign up link down below if you need. As for investment tips and stock news, just follow me lah. Just kidding, just kidding. There are tons of good channels out there. If you go to my channel, under channels, I featured several good channels that I'm following. For blogs, there are good ones like Seedly, Investment Modes, Total Wealth, and others. Just search in Google and you will find them. Finally, for forums, I'm following a few subreddits like Investing, Singapore FI, Stocks, and even Wall Street Bets. Wall Street Bets is just for memes and jokes only, yeah? Don't follow their investment advice. So yeah, that was a super simple 10-minute guide on how to start investing. I just saved you a few $1,000s worth of cost fee. Hopefully, this video helps you out. If you have any questions, just let me know down below and I will try to answer them. Like, share, and subscribe as I'll be posting new videos every Monday, Wednesday, and Friday.